Well, hello and a warm welcome to all of you to this webinar. Good to see so many people here. My name is Tom Bundgaard and I am joined with Jesper Christiansen, my good colleague. And I can see that there's so many people here. Some of you know us, but most of you don't know us. But we've been here with the company for 15 or 20 years. So that either means that we have a lot of experience or we're just getting old. You be the judge of that. But at least what we're going to try to do today is to show you how you can save $1 million on your packaging costs. And that's specifically plastics and paper and a little bit of metal. And so that's what we're going to do today. There'll be a Q&A session at the end. So you can just type in, there's a small box, a small chat box. You can type in your questions. It's only me that can see the questions. So let's see if we can answer them. Maybe there are some difficult questions, we don't know, but let's try it. I like the title actually, and it was, I think it's a little bit of a clickbait, how to save $1 million, because if you are a very big multinational company with a huge spend, I can easily save $1 million for you on a Tuesday afternoon, no sweat. But if you're a small company spending $1 million a year on packaging, it's quite difficult to save $1 million if you're only spending $1 million. So yeah, so it's a little bit of a clickbait, but we are going to at least try to save you a lot of money on your packaging. And in the process, we'll show you a little bit of how we go about doing things. So first, a few household items. This is a disclaimer. It will be here 5 seconds, but basically this blue line says we're not advising you to buy or sell anything because this is a public webinar, so we can't advise you to do anything. Once you are a client, we are very specific in advising you this is a good time to hedge, or we think it's a very good time not to hedge. So once you're inside the gate, we will do that. But as this is a public webinar, you have to take this as just food for thought, you know, and do your own sort of research as well. 2 slides on Mintec. I guess most of you know us, but like we've got 35 years of experience in this and 17,000 commodities, and we got loads of things. The new thing you could say is we actually have forecasting. We didn't have that some years ago, but we have forecasting where we do price forecasts and we do hedging recommendations, only if you're a client, of course. And we try to do that. At some point, we want to do it on all 17,000 commodities, but we're not there yet. So we have a number of forecasts, a number of commodities, but we are expanding that every year. So that's one slide. The second slide is just a selection of some of our clients. So we are in the food retail, food manufacturing, but we also in pharma, we're in industrial manufacturers, others. So we have a wide range of clients because we cover a wide range of commodities. And as mentioned, questions, we'll take them at the end, but do type it in and I'll keep a watch on it. So let's have a look at this. This is the website that you will be able to see if you're a client. The area that where Jesper and me are responsible is the forecast area. We got loads of commodities, like a huge database of many thousands of commodities. We got price change report, modeling, cost modeling, dashboards, all kind of things. But in our area, we're looking at forecasts. And the type of commodities we look at is like dairy. We got some currency rates. We got energy, and we got grains and oilseeds here. And you can see we've got loads more meat, poultry, and fish. We've got metals, paper, plastics. We got soft commodities, and we got steel. So those are the commodities we currently employ, and we expand that list every year. But today's topic is packaging, and that's in our world, when you're in, primarily we're talking food here, but then it means metals, paper, and plastics. So metals is used for packaging as well, but so we'll touch briefly a little bit on aluminium because that's used quite a lot in packaging, but we'll touch more on testliner and we'll touch more on polyethylene. So just to give you a few flavors of what different types of packaging, how they're expected to behave and how that's going to hit you in the future. So that is what we're looking at. So let me try to start just to show you a little bit about aluminium, and then I'll hand it over. Once I've shown you just a little bit on aluminium, I'll hand it over to my colleague and he will go through polyethylene with you. When I click on aluminium, the first thing you will see is our forecast. So, well, you'll get that free of charge. Normally you have to pay to see that. But the first view is just straight up, that's the forecast. So if I click here, you get the forecast straight up here, and you get it there. That means you can see our target 10, 11, 12, 13, then 14, 15, 16, 17, and we're now on the way. The active target is 18, so a decline from 17 to 18. But then you can see in the future, 19, 20, and 21. So I won't go too much into detail, but I'm advising you, I'm trying to save you $1 million on your packaging cost. And I'm saying I have already saved you $1 million because from 13, we're seeing a very big decline to 18. And if you followed that advice, that means that you would have saved a lot of money because prices have been going down. So the $1 million is already in your box, in your chest. And if the future goes as we expect to 21, and if you hedge, then you're basically going to save another $1 million there. So that's just the view here. We do advise hedging, but you know, this is a public webinar, so don't look at this hedging recommendation. It's just it has been pointing to avoid all the way from 13 down to 18. And now we've just moved it to plan because we're saying we need to be prepared for this uptrend here. So that means plan. You don't do anything, you just make plans. And then at some point it will move to partial and then to full hedging. So, and then you'll get a mail when that happens, but only if you're a client. So what I really wanted to show you is two things here when we look at aluminium. The first one is this pyramid here. This is our methodology. So how do we come up with all these targets I just showed you? Well, we do it by combining three different things. So the first we combine is the fundamentals. It means that we look at supply and demand, both in this case aluminium, but we look at speculators and seasonality, we look at inventories, we look at cost drivers, supply and demand balance, and all of these factors are then rounded up in a mathematical regression analysis that sort of takes into consideration all of these conflicting views. That is the first model, and that's what we call fundamental analysis. On top of that, we've got what we call technical analysis, which is a lot of very, very useful mathematical models. And then here we've got the macroeconomy. My strong view is anything you want to look into the future, you can't use one model. That's simply too unsecure. I mean, looking into the future already is like uncertain, but the less models you have, the more weak you are. So you desperately need more models, and that's why we're saying you can only be fluent in this if you have 3 models at least. And these are the 3 models we show. We have stuff behind the scenes as well, but technical analysis combined with the fundamentals, combined with the macroeconomy, and that gives the forecast, the targets that you saw on the front screen. So it's a combination of those three. So that's good enough for you to see, and you'll see when Jesper moves to polyethylene, you'll see a few of how these things are working. I just wanted to, before I hand it over to Jesper, I'll just show you one thing, the macroeconomy, because the macroeconomy is something that is very often overlooked in regards to commodities or toned down, and macroeconomy affects every single commodity. So if I click on macroeconomy, you'll go to a website here where we have the economy, and we forecast. This pyramid here is forecasting the macroeconomy, and we look at all of these things down here as well. You know, all things related to GDP. What I wanted, just a short detour, is that I want to show you the difference between GDP and PMI, because when we look at macroeconomy, of course we look at GDP, that's the most important thing, but in our case we tend to look first at the PMI. The PMI is Purchasing Managers Index, and it's proven to be very, very useful, because if the PMI goes up, well, then the economy goes up. And if the PMI goes down, then the economy goes down. So in itself, they follow each other. But the reason why we look at the PMI is because it's a leading indicator. The PMI peaks here, and then after a little while, the economy peaks. So we get sort of a head start by looking at PMI. So that's why I'm just telling you, when maybe you're wondering why are we looking at the PMI, it's because it's a leading indicator. Like here in the PMI peaked here, and then the economy peaked here. So sure enough, when this orange line goes down, the GDP is also going down. So everything is aligned, and that's one advantage. The second advantage is that the GDP are notoriously slow. I mean, it takes forever to publish the GDPs on a world scale and stuff. And what you can see is that PMI is every month. And so if you see this increase in the orange line, the PMI, then of course you're going to see an increase in the GDP. And if you're seeing now a decline in the PMI, guess what the GDP is going to do? Well, we don't have the numbers yet, but when they come, they're most likely going to show a weakening phase. So in that case, the PMI is a very good bellwether for what's going to happen. This is on a world scale. Of course, you can go, this is the US, so let me just zoom in. This is just for the US numbers, US PMI, US GDP. You can see how good the correlation is. So it's just an explanation why we think it's a good idea to look at macroeconomy and also at the PMI as an expression of the macroeconomy. So how does the economy act on this? Let me show you. So this orange line is the global PMI, just like I showed you before. We could have shown the GDP. It's the same thing, but the PMI has these advantages. That's why we're using the PMI. And you can see the PMI peaked here in May 21, and we're seeing a decline. What happens if I put aluminium price on that chart? Well, you get that idea that a rising economy is going to put an upward pressure on metal prices, and a falling economy is going to put a downward pressure. So you see how important it is to understand that the macroeconomy is the steamroller. That's the one you need to fix your eyes on. Again, here there is a lead-lag relationship. The peak here and the peak here, and then you got a later peak in prices, and a later peak in prices. So this is very reliable lead-lag. So we know once you see the economy starting to deteriorate, then prices are going to follow, but with a lead lag. That happened here as well. This peak here, I would argue that the real peak was here. That would be the norm. with this kind of delay. But this one threw everyone off. This was the Russian-Ukraine war. And that created a secondary sort of burst up here, a very, very violent and quick burst up, and then it fell just as sharply, or actually it fell even more sharply than it went up. But in our view, so that's of course, that's an outlier because of the Russian-Ukraine situation. But when the economy is falling like that, and if we expect this to be the peak, well, then prices should be falling. An increase in the economy, an increase in price, a decline in the economy, and a decline in aluminium prices. So you can see how closely related they are. And right now, if we sort of do the current situation, the current situation is that since late 22, we've seen sort of a little bit of an up, down, sideways move. So I would term this sort of sidewaysy. And that's basically what prices are doing as well, a little bit sideways. Mind you, this is a weak economy. The 50 line over here, anything below 50 denotes a declining economy. So the economy is weak and it's declining. Anything below 50 is bad for the economy. And so that's also giving a downward drag on most commodities, which is why aluminium has been so very, very low. But I would say on the short-term basis, even though this is a big downtrend, on the short-term basis, we're seeing some sideways move, and that's being mirrored, at least partially, for a lot of commodities right now that are moving sort of hesitantly sideways, not strongly up, not strongly down, but sort of hesitantly sideways. So I hope you understand why we do a lot of work on the macroeconomy, because it's such an important thing. And we do actually a webinar every single month on the economy and how the economy will affect. And we have forecast the orange line, which is the PMI. We forecast where it's going. So we have that behind this. If you're paying client, we get those monthly if you like, and you can replay them. But here is just to show you how important macroeconomy is, and it's a big part of our three big things we're looking at: macroeconomy, mathematical models, and fundamentals. So I think that more or less does it for me right now, and then I will leave the scene, and I'll get back briefly because now Jesper will do polyethylene, and when he's done, I will do a little bit of forecasting on the testliner thing. So first of all, I just need to make Jesper a presenter so you can see his screen. And while his screen is moving up, if you have any questions on aluminium or macroeconomy, just type it in and we'll get to it. But you should be able to see Jesper's scene. Welcome, Jesper.
Well, thank you, Tom. And it's very nice to see so many people here today. It's just a pleasure that it is of interest to a lot of people. I would like to start off with, before I go into detail with the forecast on plastics, I thought it was interesting to have a look at how historical plastic prices have been moving. And this here is a graph showing more or less 20 plus years of plastic resin prices, with ABS prices being the most expensive one and PET prices being the cheapest one. The key takeaway from this graph here is that it's very clear and obvious that there is a high correlation between the different types of plastics. So if we see prices move up in a period, well, they all move up more or less to the same extent. There are some differences in the volatility and the amplitude and so on, but in general, they follow the same trend. When prices fall, it's the same, and it's the same when they go up again. When they drop a bit, they go up and they go down, and they go up and they go down. So it is very obvious that there's a high correlation between the different types of plastics. So no matter whether you are looking at ABS, PET, or PP, or PS, they follow the same trend. And that is a very, very important takeaway. Another thing that I would like to address before we go into detail with the forecast is that what about regions? What is the situation if we compare prices of the same type but across regions instead of type? Well, I prepared a slide showing this also here. And in this case here, you can see the price of PE across 3 regions. The red one is US prices, the blue one is European prices, and the green one is Chinese prices. It is very obvious here also that there's a very high correlation between the regions. And it's also evident that Chinese prices are usually the cheapest and US prices are usually the most expensive one. Another very important takeaway from this here is that if we look at some of the, if we try and have a look at the lows that forms here, we can see that there's a tendency for Chinese prices actually to move before the other markets. So they make a low before that is transferred over to European prices and later on to American prices. We can see the same over here. Chinese are bottoming first, then European prices, and then we can see that American prices are following suit. So that is also a very important takeaway, that even across regions, plastics have a tendency to follow the same trend. So now we've taken care of this, and I think it's time to go on and have a look at the forecast. And let's start by having a look at polyethylene and our forecast for polyethylene. This here is the landing page. This is where you end up when you enter the analysis for polyethylene. And you start by seeing this graph here showing the forecast with all the targets. There are historical targets, the 1, 2, 3, 4, 5, and we have 6 up here. And most recently, we have seen quite a deep downtrend towards target 7. On the right side of the screen here, you can see the hedging recommendation, which Tom touched upon briefly, and you can also see the trend currently in the market. We are showing it here as a downtrend, and in this case here we show this with green color because we tend to look at things from a buy side, and a green color is a positive color in that regards that prices are falling. When we look at the forecast here, we can see that the active target right now is target 7. And that means that prices are in a downtrend. We have a hedging recommendation that's on plan. That means we do not yet have any signals indicating that target 8 and 9 and 10 is going to be valid targets. So for now, we can only focus on target 7. And that means that we do not recommend that you do any hedging at the moment, because we need to make sure that we get confirming signals that validate a potential uptrend before we enter the market and do any type of hedging. So, but the big question, of course, is how do we derive at this forecast? And to try to explain a bit about that, we need to go in and have a closer look at some of the type of analysis that we do. And I would like to start off with the macro, and just have to scroll down here. And this is the same graph as you have seen earlier, where you have the global PMI, which is the driving force behind a lot of the price movement that we see in many markets. When we then put on top of this the PE price, well, it's quite evident that there is also a high correlation here. And again, as we saw before, the PMI enters a bottom beforehand, so it's a leading indicator, and then prices turns around afterwards. We see the same up here, where we have the peak in the PMI before we get the peak in PE prices. Tom also mentioned that we did get this second peak or second move up here. That wasn't really part of the original plan, but that is of course because of the situation with Russia invading Ukraine, and that made a lot of uncertainty in the markets, and that made many prices move up further. If we look at the trend in the PMI, we can see that, well, the trend is down. It's quite evident that the movement in the PMI is to the downside, and that of course should put a downward pressure on prices. However, as Tom mentioned, lately we have seen some sideways price action, and that of course could end up with some sideways price action in many commodities. That could actually also mean a bit of upwards price action in some commodities, depending on where they are in their particular movements. So the PMI has been pushing down on prices for quite a while, and we have seen quite a bit of weakness in many commodity markets. If we go up a bit here and look at another very important graph we have here, and that is the regression analysis. As Tom mentioned, we had the pyramid, and in the bottom of the pyramid we have all the fundamental factors, and all these fundamental factors are combined in the regression analysis. And the regression analysis is what we see here with the estimated price here. On top of that, we have the fair value range, which just gives a range for the price to be within, and then still be viewed as fair. If we look at the graph right now, well, we can see that there has been some what we call bubbles. We had a bubble up here, and this bubble continued further. And what we know about bubbles is that at some point they burst, and when they burst, prices will have to re-enter the fair level again. And we have seen a huge decline in prices, and prices have actually re-entered the gray band down here. So at the moment, prices are actually being viewed as reasonably fair. When we see such an increase in or decrease in prices, and prices have been out of sync with the fundamentals, and they finally get back to where they ought to be based on the fundamental situation currently, we sometimes see prices revert upwards again, or so there's at least some risk that there's going to be some upward pressure, but with the regression analysis still moving down, any upwards price action ought to be very short term only. If we are to see something that's going to be longer lasting, it will mean that the regression analysis will have to turn to the upside, and currently we are still looking at a regression analysis that is pointing downwards. Another important factor that we look at when we analyze commodities is cost and profit. And if we look at this graph here, we can start by looking at the PE price. If we put on top of the PE price the estimated production costs, then we can get the theoretical gross profits. And if we look at the orange line right now, we can see that it has been moving somewhat sideways. Prices of PE have decreased dramatically, so has cost, but profits have actually kept on a very high level, way above what it ought to be or have been in historical terms. So being a producer of PE right now, well, that's not a bad situation because you are earning quite a lot of money. The issue, of course, from an analytical point is that, well, we are getting some indications that we could see some sideways price action based on some of the other fundamental factors. And looking from the profit side and from cost side, well, it would likely not be a lot of upside potential because profits are now still so abnormal. So if we're going to see some upward price action, it is likely to be followed by some upwards price action in the cost side also. The last graph that I would like to just quickly address here is the seasonality, because seasonality is also quite important in many commodities. And here in the case of PE, well, we can see that there's a clear tendency for PE prices to increase in the first part of the year, then it's going to go down into summer, and then the last part of the year is somewhat wobbly. No real strong movements based on from a seasonal aspect. And this seasonal aspect is actually some of the things that we can address, because currently our forecast is pointing to a near-term low, and from there we are going to see some upward price action into Q4 and perhaps later into Q2 of next year. That is what the forecast is pointing towards. But if we're going to be surprised, it is likely going to be in a weaker increase, or we're not going to see any increase at the moment, but it's going to be postponed a bit, perhaps all the way to October before we're going to get the increase. So if we go back to the forecast again and look at the graph here, well, if we're going to look at something that is going to surprise us, well, then it could be that prices will not start to increase already to target 8 from a near-term low, but we are actually going to see a bit more wobbly, and then prices are going to continue down a bit further into October before we then are going to get the increase that we are forecasting towards target 8, 9, and 10. So the next point I would like to address is the technical analysis. I won't go too much into detail with the technical analysis, but the technical analysis is based on a lot of mathematical models. We focus on 3 important technical indicators in our analysis, and that is the moving average, which we see up here. In the graph here, we have the price, that's the orange line, and then we have a moving average, that's the black line. The black line is used to identify changes in trend. So when prices crosses above or below the moving average, that is usually significant because it indicates that now there's a trend reversal in taking place. We also use the MACD and RSI to both verify the changes that we see in trend in the moving average. So a break above the moving average, we'll like to have it confirmed by the MACD. So for example, if we look at this here and say, well, we have here a break below the moving average right here. And this break is confirmed by the MACD. So this indicates that we are likely entering a new, potentially longer downtrend. Then we get a break above the moving average again, but this is not confirmed by the MACD. So the MACD is actually saying that, well, the stronger force in the market right now is actually down. And this here is only some upward short-term fluctuations before prices are going to continue down further. And that is exactly what happened. We are also using the RSI. And we are using the RSI in two ways. We're using it to verify breaks above the moving average and below the moving average, but we're also using it as a warning indicator. So the RSI, it's called Relative Strength Index, and it returns a value between 0 and 100. The important levels are 80-20 and 60-40. 60-40 is used to identify changes in trend. So an uptrend should have an RSI crossing above the 60 level, and a downtrend will have to have the RSI go below the 40. And another thing that we can use is the RSI level 20 and 80, because 20 and 80 is a warning that there's likely going to be a peak or a trough nearby when the RSI goes above 80 or below 20. For example, in this case here, we have an RSI above 80 and we get a peak in price. We do get a low RSI here and we get a low in price. We do get a bit of upward price action, but we don't really get anything above the 60 level, which should indicate a change in trend. So the trend is still down, and right now the RSI is very low again. It is actually entering or getting very close to 0, so there's not much downside potential left, and that is supportive of the target 7 being close, and that we are going to see some upward price action in target 8 and very likely also into target 9 and 10 later on, looking into the early part of 2024. Well, that was what I had prepared, Tom. So if you want to take over again and continue.
Yes, certainly. Thank you. Great topic. So I would just reiterate, we're trying to save you $1 million. I mean, we're good people, so we're trying to save you $1 million. And I would say the same thing that I said with aluminium. From 6 down to 7, you've saved probably much more than $1 million because you knew prices would go down to 7. Once we get a buy signal, and as you said, Jesper, we don't have the buy signal yet, but once we get it, this increase to 10, if you can hedge that and remove it, then you'll save $1 million again. So good stuff. So let's go in, and I can see that you're already putting in some questions in. I look forward to answering them when we're done here. I'll just end up with Testliner. Testliner is something like packaging is really something that clients have asked for many years, and we've finally this year been able to add it. So I'm really happy about this. Testliner, as you can see, has had a strong decline down to target 1. This is called target 1 because this is a new analysis. We just this spring we added Testliner. A lot of clients have asked for it. The more clients that ask for a commodity, it gets higher in the priority, and we get it on. So we've been saying avoid hedging during all of this decline, and so you've saved again some money. But now we're saying plan because we think it looks like we're ripe for a target 2 increase. And at least that's what we are expecting. So let's have a quick dive into some of these. This triangle, you can click on them. The regression is the fundamentals. So as you can see, like Jesper was explaining, whenever you have a price up here above the gray band, it's a bubble. There's also a bubble here, and it has to burst, and this one has to burst, and it has to go into the fair band. And that's where it is right now. So that means that this decline in packaging means that Now prices are actually fair, and that means there's no strong pressure on prices. Once prices are inside the fair band, prices will follow whatever the fair band is doing. Like, for example, here, prices dropped down to here. Now it's inside the fair band. The fair band is moving down a little bit like this, and prices are wobbling around here. But once they start to go up, then prices starts to go up. Right now, it means that prices are fair. What we do is, like we're saying up here, don't hedge. I mean, hedging is a question I've got, and I'll talk more about that. But up here, this is not sustainable. Prices have to go down. So don't lock in prices to suppliers. Whereas if you do it here, like this is a very, very low price. This is almost an anti-bubble. Prices are too low. It can only go bad. It can only go up. And so you need to secure some supplies in order not to get that price increase. So you can see how concretely you can use these numbers. The conclusion right now is the market is under no pressure to do anything because it's fair right now. So that means we don't do anything. But if we look at some of the fundamentals, let's just look at a few, just two of them. If you look at the market watch here, look at seasonality. Like the seasonality is what Jesper also talked about. This is the seasonal from January to December. We see typically a decline until August. And then you're saying, oh my God, we are in August, right? At the very end of August. And what am I facing? I am facing a typical seasonal increase until November. So I know from a buying perspective, I am standing in front of an increase that is potentially. Seasonality doesn't repeat every year. If it's a high correlation, it's maybe 8 out of 10 years. So nothing is ever certain, but it just shows that you're looking at a rather big risk to the upside, especially because we're now in August. So that's the seasonal perspective. If I then go back here and say, what about, let's say, cost drivers? There's a lot of different cost drivers inside of this, but let's just go in here and look at the final conclusion here. This is the price decline we've seen for testliner, and this is the cost price that it costs to produce testliner. And you can see they match each other. So it's not like this big decline here in price means that now they earn no profits. No, because their cost has actually been going down. And they have, you can say the suppliers have given you that cost price decline. So that's good and fair. But the question is, what is the profit? So if you look at the profit here, that's the orange line. And now I'll just delete the cost. As Jesper showed you, the orange line is profit. What is the profit? And the gray box always shows what is normal profits. So that means in real time, you can say this is abnormal profits, way too high, and that's not sustainable. Just like this is too little, and like this is too low profit, and that's not sustainable either. So that means that this price would have to go up. And you can see that profits are now right in the middle of the band. And that means it's comfortable. There's no pressure to the upside or the downside. So it means that if we get a seasonal increase inside this band, you can easily get sort of a seasonal increase in price. And that would mean sort of a limited increase. But it's going to be rather mild, because there's no strong pressure upwards or downwards, because profits are sort of in the normal end of it. So the idea is, if we sort of combine that with the technical analysis, and I won't show more about the technical analysis like Jesper already told you, but a break above that black line would be the start. That would be the confirmation of target 2. We act only on confirmed signals. We don't want to act on anticipations. Anticipations are the mother of all problems. We only want to act on signals. like a break above the moving average here was indeed the start of an uptrend. A break above the moving average here was indeed the start of a short uptrend. The duration of either a short or a long one is different, but you can see we don't have a break above, but that could come at any time. You can see it's touching. So maybe in a few weeks' time, we'll get a buy signal, and that's what we expect. So what we're saying to people, like, you need to plan and be ready for an increase, but don't do anything until we get the signal. And then, as shown, we will send a mail out to people who subscribe to us, so you get it in your inbox, so it's not, you're not losing out, because you will get that reminder. Jesper also talked about what we call alternative scenario. We always work with alternative scenarios, and when we look at this, we still think the alternate scenario is that prices are still going up, just like the primary scenario. But in the alternate scenario, this movement here will just continue sideways, make a little bit of a drop, which is not normal. It won't normally go down. August is the lowest point normally, but it could drop into September, and then it would do an increase. So in both cases, in both scenarios, it's going to be an uptrend. It's just a question whether it starts now or whether it starts, in a month or so time. And that's the same alternate scenario that Jesper is having on plastics. It will either start now or it will start in October, the increase, I mean. So that is the idea, and I think this makes sense from a technical perspective, and it makes sense from a fundamental perspective. There's not the short increase here is kind of small, and that's because there's no real pressure to do a lot of increase, because the profits are, fine. And the last thing I wanted to show you with regards to testliner, in Europe, we typically look at testliner because that's what most people are asking for, that most people are buying testliner. I've been a purchasing manager for many, many years, and I have bought testliner and kraftliner and fluting and all kinds of things, and cartons and stuff. But testliner is the European. I could, just for fun, show you. I'll go to the database here. This is the database with the 17,000 commodities, and here I could just add. Let's say I want to add kraftliner. So PA06. That is the kraftliner for US. And so now we have the red line, which is the US prices, but for kraftliner in the US, because in US there's much more emphasis on kraftliner and less emphasis on testliner. But you can see that the US prices have also been dropping, just like Europe, like the testliner for Europe, but the testliner has been dropping much more in Europe, and so the decline in the US has been less. But you can see that the trend seems to be more or less the same. So if we get an increase in Europe, we are likely going to get an increase in US as well. But we're not forecasting the US right now. We are working on it, and this red line will start forecasting that. I can't give you a time but within the next half year, we're already working on it. So at some point we will add the kraftliner US to the list of commodities we're looking at. But it's just to show you how easy you can compare different time series here with yourself if you want to. So now I'll just go back here to the testliner. So what I want, before we get to the questions, we have 10 minutes to answer your questions. I just want to get a conclusion in. What you can see is that we're looking at aluminium, we're looking at testliner, and we're looking at polyethylene. The trend here, it's still down for polyethylene, it's still down for testliner, and it's starting to move sideways for aluminium. But what we're saying is all three of them are very, very close to the low point. Either the low point is almost in, that's the primary scenario. The low is going to be in very soon. We've saved money all the way down, or you have saved money. And if aluminium starts to go up, and testliner starts to go up, and polyethylene starts to go up, that's going to hit you on all three sides. So it's not about turning the other cheek, because you'll get hit on the other cheek as well. So you need to start preparing. What will I do if prices starts to go up? How can I mitigate that upside risk? And the original, the primary scenario and the secondary scenario both talk about an increase. It's just a question whether the increase starts more or less immediately, or whether it starts, in September, October. In either case, you're going to get hit. So that's our effort to try to save you $1 million, and now it's your turn to go in and secure the $1 million. So, but the idea is we only hedge this uptrend when we have the signal, and we are monitoring that every single day. And when we get the signal, we'll send a mail to you, if you're a client, of course. So now let's get to questions. The first question I got was from Isabel. She said paper, and that means testliner. It's not traded on the market, so it's not a market like an exchange trade. Nevertheless, are there ways to lock in a good price for a certain time? This is very difficult for testliner. I have been hedging myself personally. When I was a purchasing manager, I've been hedging aluminium and steel and soft commodities, and some of them are very, very easy to hedge, and some of them are a little bit more difficult. I will say that testliner is one of the most difficult, because there's no ready instrument where you can do it. And when you try to talk to the converters, the ones who are making the packaging, they resist trying to hedge testliner. So I would say this is one of the most difficult ones. I haven't found a good way to succeed with that. Basically everything else I've succeeded on it, but testliner is pretty difficult. I know there's advanced users out there. I've talked to a few of them that can do it, but they do a little bit different things and a little bit special things. But you have to do something special in order to hedge packaging like this, testliner. So primarily why people are interested in this is because then they know the pain is coming, and they can start maybe buying finished packaging, in excess quantities, and inform management that this pain is coming, and so on. That's basically what you can do. Another is a question from Irina. She says, aluminium, we started with aluminium, and I got another one from Lars, and they're basically saying the same thing. One thing is, like aluminium, you're tracking the price of aluminium. But what about the premium? So that's what Lars is asking about. What about the premium? Well, that's part of it. So if you look at aluminium, and of course, premiums is something that is part of all of these fundamentals. So we look into it. So inside the market watch here, I'll just scroll down to the relevant graph here, and then I'll do it like this. So this is the aluminium price. That's the raw aluminium price that we forecast. But we do have several graphs that shows the premium, like the premium for West Europe, and we have another graph showing the premium for the US. But so we do follow that. But the if you take the aluminium price and then add the West Europe premium, it looks like this. So the yellow line is aluminium price plus the premium. And what do you see? Well, you see that there's always a difference. Of course, the premium the premium is always higher than the real aluminium price. But you can't do anything about the premium. What you should be focusing on is not the level, but you should be focusing on the trend. So if the black line has an uptrend, you can bet yourself that the orange line will have an uptrend. And if the black line has a downtrend, you can bet that the orange line will have a downtrend. So you should be much more concerned about the trend than the premium, because the premium is just, these two are a mirror image of each other. It's just a little bit extra cost on top of the black line, but that's it. So you can see how little the premium is actually. It's not like you have a downtrend in aluminium and then when you add the premium you get an uptrend. No, it's the same trend. So the trend is much more important. But a very good question, yeah. Another question here is about the seasonal change. Where does it come from? From LDP? In fact, when we look at every single commodity, we calculate the seasonal tendency. And so if I click on the market watch here, let me show you, we calculate what is the seasonal pattern. So you typically from January see a strong increase to April. That's the peak of the year, a decline like Jesper was telling. So the question is just, is that increase we expect, is that starting here or is it starting here? I mean, both are valid, but we know that typically there's very little movement in terms of price action here. So we calculate how the prices are doing over many years. This is what we call static seasonality, and we also have dynamic seasonality. And in dynamic seasonality, these are the seasonal patterns over time. So we actually do, you can see that the seasonality is growing. So if I just draw, you can see the peaks are getting higher, and you can see that the lows are sort of almost getting a little bit lower. So the seasonal aspect is getting bigger and bigger. And then we're saying, like, if I take this last year's seasonality and just duplicate it here, well, then it looks like that. But if I then add that percentage to the price, then prices are going to see this increase if only seasonality was there. So that means I can see how seasonality develops over the years and if it's growing bigger or smaller or stuff like that. Yeah. So I've got some questions from Kim about what is driving profits to stay strong against the downtrend, and also what negotiation measures can we use with our suppliers to take advantage of the production costs that are lower than profits? Yeah, so that's the whole point of this actually. So it's a very, very good point. I would say all of this, what we show on the website, if you go to your supplier, I would bet that you are buying 50 different things. So you need to know about 50 different things, but your supplier is, let's say he's delivering polyethylene. He only has to focus on one, so he can go deep on that one. So he has an unfair advantage. It's called a tilted playing board. He has the advantage because he can focus all his energy on one commodity. That's why all of this data is here, and it's updated so that you know what he knows, and you can sort of not get fooled by him. So it's precisely the negotiation measures that you talk about, Kim, that's important. So one thing I often hear, like they're saying, then I've been buying plastic for many years, both from Europe and from the US, not from US, but from China. So they'll say, oh, look at this big price decline I'm giving you. Like, how can you have to be reasonable. I put prices down for you. They'll say, the supplier will tell me. Yeah, that's true. But, he's barking up the wrong tree, because I'm saying, look, your cost drivers has fallen so incredibly much, right? So of course you have to give that to me. But The problem that you are not talking about is that the profit here, so let me just show that. This is normal profit. The gray band is always normal profits. So if the supplier is crying down here, he's got a good reason, because his profit is abysmal low. But up here, he's laughing all the way to the bank. And they only have this excessive profits, you know, in certain market situations, and he's taking advantage of you. He's having way too much profit compared to previously. So once you see this, you realize what he's into and the kind of profit he has. And so you can start negotiating based on that. Not negotiating based on, oh, prices are really falling and they're really low, so they're abysmal low. No. The argument is that your profits are way too high. You're taking advantage of me. You've got to do better. So everything we're showing here on the website is something that you can use in your negotiation with these suppliers. And in fact, we made it easy for you, because when you go to the overview of, let's say, PE, we have a download pack. So let's say you're going to a supplier. So on the plane, you can just take the executive summary, or you can take the detailed summary and then download it. And then you get everything, and you can prepare for the meeting and sort of expose his bad arguments, right? So this is basically also for negotiation. So I can see that we got more questions, and there's loads of those that are really interesting, and I would like to, wow, so many. We can't do them all, sorry, because we are already 1 minute past the hour. I've taken up, well, me and Jesper has taken up way too much of your time already, but I hope you can see this is useful, it's interesting, and if you want, you can mail us and we'll be happy to get back to you. And then actually, you know, I think this is enough just to show you how you can use stuff, and there's loads of questions we can go into. But the final question, I just have one. Do we have access to Mintec? Where do we find the link? Well, you go to mintecanalytics.com, and if you're a client, you can get on, and if you're not, we are ready to welcome you. Just get in touch with our sales team. The final parting gift, if you look at there's a small dropout here. We got something called handouts. I'll just show it. It looks like this. Just a second here. So it's called handouts. We've got Mintec market movers and a market briefing. So these are 2 handouts, just an extra thing you can get if you want. But with that said, I think Jesper and I will just say thank you. You have been an orderly group, and I'm really happy about all the questions. Sorry, I can't get to them, but if you want them answered, just send us a mail. Hope you enjoyed it, and look forward to inviting you to another webinar in the future. Take care.